Hey, good afternoon. My name's Jake Gronowski, principal and founder of 12 South Advisory. We're doing our weekly Facebook Live here on a topic regarding inventory. Um, we'll get started here once I share my screen. All right, so LIFO, FIFO, and average costing. What's the difference and why it matters within your business? So this particular topic that we're going over today kind of relates to companies that are in the manufacturing space as well as perhaps construction or anyone for that matter that has inventory on hand, whether it be raw materials, work in process, also known as WIP, or even finished goods. So, as you may know, inventory sits on the balance sheet. There's multiple ways that you can value it. Three ways to be exact. We've got LIFO, which is known as last in, first out, FIFO, first in, first out, as well as average costing. Um, so simple enough. So why is it important? So warehouse inventory, um, may imply different taxes and different profit. So it depends. Do you want to be taxed higher in a higher tax bracket with higher income, or do you want to be taxed lower? It all depends on your goals within the organization and the company. So inventory costing method you choose affects a multitude of different things, including profit margin, job costing accuracy, even financial statements, the amount of tax that you pay within your business, as well as decisions that you as a business owner make for the company on behalf of the company. So this is just a sample balance sheet here. As you can see, just wanted to show you where inventory sits on the balance sheet. As you may know or may not know, the balance sheet portrays assets, liabilities, and owner's equity at a certain point of time. So oftentimes it's at the end of the period. So it'll be at a specific date and time or specific date. So often, the end of the period being December 31st for calendar year companies. So yeah, inventories are a part of the current assets. Roll up. So it sits just below receivables and below cash on the balance sheet typically. And then more long-term assets sit below the current assets section. And then after long-term assets, you've got your total assets, and then total assets equal liabilities plus owner's equity or stockholders' equity, whatever you want to call it. So that's the balance sheet. So getting into LIFO here, LIFO, as we discussed, last in, first out, it values inventory as the most recently purchased inventory items, whether it being raw materials or even finished goods, um, are being recorded as sold first. So the newest cost of sales that are purchased are the first ones to be expensed, and older, lower cost inventory remain on the balance sheet. One con of LIFO is it is not involved or allowed within IFRS. So anyone that is not within the US and is using international financial reporting standards, which um, all countries outside of the US are on IFRS standards, and then us here in the US are on US GAAP. So United States generally accepted accounting principles is what US GAAP stands for. But here in the US, we could use FIFO, LIFO, or average costing. Whereas um, if you're not in the US, you can't use LIFO. So why use LIFO? It matches recent costs with recent current revenue, reduces taxes as cost of goods sold are going to be higher and net income would be lower. And then potential short-term cash flow benefit being lower profit and lower taxable income, keeping more money in your pocket when it comes to taxes. Getting into FIFO or first in, first out, it values inventory as the first purchased inventory items. Um, again, whether it be finished goods or raw materials, recorded as being sold first, often follows the oops, this is not true here. So jumping back to FIFO, excuse me. The oldest cost of sales are expensed first, and this often leads to a lower cost of inventory remaining on the balance sheet. So why use FIFO? Because it's accepted under all accounting standards. It often portrays a stronger look to the balance sheet, higher profit and higher income, but it also higher taxes in the meantime. And it also reflects the natural flow of goods, um, especially perishable items. So moving on, the last method of inventory is average costing method. So average costing method kind of takes into consideration the average cost, the total cost of goods that you purchase, or the total cost of the inventory divided by however many units are available on hand. So oftentimes the figures fall in between that of LIFO and FIFO. So um, your ending inventory is going to be um, kind of in the middle here. It's going to be ending inventory would be lower than FIFO, but higher than LIFO. So I'll get to that comparison sheet in a minute. Average costing method kind of portrays smoother earnings and less volatility in margins. So yeah, comparison. So LIFO here, last in, first out. So I've got an example here of an HVAC company. They purchased on January 1st, they purchased 20 Train HVAC systems for 2,000 each. And then later that year, they purchased 10 more for $4,000 each. And then later in the year, they sold 12 of these. So just going to pull up a calculator here and we'll do the calculation to the side here. So, so yeah, altogether they have 30 in inventory before the sale of the HVAC systems. So essentially for LIFO, they're going to take last in, first out as the acronym as it stands for. So it's going to wipe out these 10 Train HVAC systems at $4,000 each. So, and then it's going to wipe out two of these older Train HVAC systems at $2,000 each. So essentially, 10 times $4,000 plus 2 times $2,000 each. So essentially, $80,000 worth of inventory total. So 2 times 2,000 plus 10 times. But anyway, you get the picture, right? So, so yeah, ultimately ending inventory would be lower than that of FIFO, and it would be a higher COGS under LIFO. So essentially that would mean lower income and lower taxes, of course, because the cost of sales would be higher and your net income would be lower, essentially. So moving on to FIFO, first in, first out is what this stands for. So the same problem here, same figures. So they sold 10 train HVAC systems on August 1st. So first in, first out, as it states. So they essentially factored 12 of these train systems were sold, and then so there'd be 8 left over. So essentially, um, ultimately a higher ending inventory on the books, and then lower COGS. So ultimately, your net income would be higher, and you know, of course, higher tax. So average costing is kind of the in between the LIFO and FIFO, as we said. So the same problem again. So you just take 20, so $80,000 total divided by 30. So that would be just over just under $6,700 per train system, train HVAC system. So if they sold 12 of those, the ending inventory would be $48,000 and cost of sales would be $32,000. So, so yeah, just a recap of what we covered. There's no right or wrong when it comes to how you value your inventory. But yeah, like we discussed, the one caveat of it was LIFO is not allowed under IFRS, um, but it is allowed under US GAAP. So it's best to choose a method and stick with it. Consistency is key. Consistency and accuracy are two of the main assertions when it comes to accounting. Changing inventory methods would also reflect a need for change in accounting principle, which would also require financial statements to be restated, um, starting in the period that the accounting change was made. So changing inventory valuation methods impacts, taxable income, cash flow ratios, and financial ratios and valuation. So altogether, it's best to think twice before going through with any sort of change in inventory. So that's our presentation for today. Yeah, you can get in touch with us on Facebook, Jake Kronowski CPA. We're also on Instagram and LinkedIn. But yeah, reach out if you'd like to book a call with us. And yeah, thank you so much for tuning in, and we'll see you next week.